Live. If you can hear us in the community, if you're on YouTube, say good day. We've got a very Christmassy special for you here. I'm joined in the studio, none other than Dr. Andrew Dermott / Drew Meredith.
In my Christmas shirt, hopefully.
Christmas shirt indeed.
Trying to look like a Christmas tree, a bit of texture.
Yes.
You do.
Always good to be excited for this one. Haven't been live for a while.
And we haven't been joined by Jamie Nemtsas for a while. Jamie, how you going, mate?
Really good. Really good.
Yeah.
And heckle away.
Yes. Bring the Christmas cheers.
There's always
a lot of heckling from in this room, I think.
Jenny from Queensland says, it's a bit wet up here. Got the timing correct, though. Woo. Well done. Derek, good to see you. Luke with a comment in the chat, chuckling on the email a couple of hours ago, equating Drew and Jamie. I think I may have mentioned that there's 50 years of experience between the three of us. I am the underweight here. Like, I am not nearly as many, but he's just retracted the message. So there's something going on there.
Something strong with the heckling.
Yeah. Aisha, Merry Xmas from sunny Gold Coast. Well, glad it's been bloody hot up there.
Did we just hear it was raining in Queensland?
Yeah.
Sunny.
Yeah, it's pretty warm down here though. So we've got questions sent in advance. We've got your questions coming through live. We've got a wealth of knowledge here in the room. Drew has been teasing us for months on the Australian Investors podcast about something or other to do with a live tasting. So we'll get into that in just a moment. We have a bit of an update, just what's happening in the world of finance and investing. Got some questions about the S&P 500 versus NASDAQ, some changes to some technical things at APRA. And someone's got 40% of their portfolio in one stock, and they just want to get some general thoughts on that. And we'll give you some of that for sure. So maybe to kick things off, gents, I thought I'd ask you a question, just a general question, maybe starting with you, Drew, is that, one thing that you're taking away from 2024, maybe it's a lesson, maybe it's a conversation, maybe could be anything, just something that stands out for, the year that it still is, but the year that was.
And it could be the same thing we say every year. And I reckon I'm going to steal one of Jamie's here, as you hear every time. Yes. Every time he listens, he says something he said at the office.
Which is we share offices, so we're in the same office, and Drew and I have a conversation, and then on Saturday morning I listen to your podcast, and it's like, hey Drew, that's my idea, that's not your idea. So you're probably going to
all
steal
content's
mine
good content.
Right now.
You know what? I actually did joke about this with Monique this morning. I wanted to go back in the archives and pull every time Drew said something that Jamie, my business partner, is
the brains,
because we'd probably get the whole year's worth of footage from that. But what do you got, Drew?
I mean, and this is a big topic for us. We've talked about it a bit in some of Waddle's production as well, which is if you want to learn anything from 2024, that the headlines mean nothing. Ignore every headline and we do a fair bit of media, but
good one.
Be careful of the media. I think CBA was like the lightning rod. I'm hoping he didn't come up with this one as well. He probably did.
No.
CBA was like a lightning rod this year, and everyone's had a call on it being essentially the consensus has been that it was overvalued, but it was overvalued from something like $90 all the way up to $150. I think it's still over $150 at the moment. But what it was saying, there's enough reasons to sell CBA, there was enough reasons to sell NVIDIA, there was enough reasons to sell the ASX, the S&P 500, everything, every day. So the lesson, again, is just don't stop reading all the news, but filter the news and ensure you're making long-term decisions, not short-term reactionary ones. And I think that kind of reflects to me is also sticking to the course. Like if you've got a framework to make decisions, well, you're not as worried about what someone's saying about CBA on
absolutely.
The news.
I mean, we used to call it white noise, right? It's not white noise anymore.
It's really loud.
Yeah, that's right. But there's an enormous amount of noise around. CBA is a perfect example where the stock's probably gone up 40% since everyone called it.
And continue going.
And it's a good lesson for everyone. An overvalued stock, if it's overvalued, doesn't mean it's going to become undervalued. An overvalued stock can become more overvalued and more overvalued. It's like a bubble, right? A bubble keeps growing until it pops.
Like Pro Medicus.
So
not bubble, but a stock that just you
can
can never buy.
Pro Medicus. Daniel in the chat says, Magda, make Andrew Dermott great again. If you're new here, Andrew Dermott is Drew's alter ego, says the future Reserve Bank governor for the baby range. Interesting.
The baby range.
Yeah, I don't know where he's going with that. But no, that's a fair point. Like at the beginning of the year, we've had a lot of smart people on the show. You guys had a lot of conversations, probably a lot of clients with CBA. Everyone's worried. Everyone's prognosticating about the future. still the thing's gone up.
particularly around this time of year.
Yeah.
Still
Exactly.
about
Yeah.
framework. I mean, we run portfolios, right? So it's
Yeah.
all about frameworks and decisions and diversification. So I really like this methodology because it essentially allows you to sell high and buy low. So you wouldn't necessarily, if you're wrong on CBA, you probably then are going to have inertia and not sell it now. But if you can look at it through a framework and go, you know what, this stock is now an overweight position and I'm going to rebalance it back to core, all you're really doing is selling high, which emotion is incredibly hard to do. If the stock falls off and it has issues, which banks do every 5 to 8 years, you can always top it back up. So how do you make those decisions? And similar to Drew, I think what I learned in this last 12 months is the power of the US. And we often forget about how powerful the US is. And I went there 3 times, and it's an incredibly amazing place in terms of how innovative, you know, the Fab 7 all come from US. And I might talk about a bit later about people we met, and the people that I met, you know, these entrepreneurs from MIT, which are just unbelievable when you think about what they're doing. So the power of the US can't be forgotten. Best performing market for the last 12 months.
And it's just going to accelarate with the DOGE, the Department of Government Efficiency. And Musk and his cohorts, whatever you want to call them, are coming in with this mission of cutting red tape and bureaucracy from whether it's actually executable, but like letting those animal spirits run. And the US has always recovered from every recession, every challenge because of that approach to capitalism.
It's quite interesting. Mine is actually the pace of which AI has probably caught on.
Good one.
We kind of, was it 2 years ago basically now, ChatGPT kind of hit the world.
Right,
and,
at this time too.
at this time actually. And
I've seen AI does podcasts now. You two might be out of it.
This is actually an AI. Right?
This is not us. So I think that's really caught people off guard as the pace of innovation definitely caught me off guard. You could always see that like the other tech companies were going to adopt AI, but just how quickly. And it's like, back in the day where you would get like a Microsoft Windows disk from JB Hi-Fi or something, you install it on your computer, then you could probably go like 3 or 4 years before you get another one. But now, because of cloud computing, the AI tool gets updated tomorrow and your one today is updated instantly. And all of a sudden you see progress and innovation. And that's been really, really interesting. And it kind of goes back to your point. I know you spent some time at the unis over there as well, and some of the innovation. Like if you want to chat about that, feel free. Otherwise, we can bring it up later.
So we were part of a study trip. I went on a couple of study trips this year. One was to the US, one was to South Africa. But the one in the US, we happened to have access through a fund manager called Safar, access to MIT and Harvard. And Safar is a VC fund that actually partners with graduates of MIT and Harvard to fund their ideas. Really interesting stat, MIT, a third of everyone that graduates MIT starts their business straight away. So if you compare that to Melbourne Uni, I don't know the stats, but I suggest Melbourne Uni is probably 3%.
12 people.
So you've got this, and then MIT's got an interesting structure where they'll take an equity stake. This is not the endowment, but they'll take an equity stake in their startups. And we had a dinner the first night, and 3 young men in their 20s came out and they started talking. And the first one says, just submitted a paper for a Nobel Prize. It's around nuclear fusion. I've proven cold fusion is hard to do, but you can actually do it at temperature. So I've created a magnet system that can hold nuclear fusion. Started business kind of 2 years ago. It's now got an $8 billion market cap. I'm in a trial system. It works. I'm pretty sure that I can solve the energy problems of the world. Right? This is a kid that looks like my son. Okay, this is phenomenal. And then we met this guy. The next guy got up and goes, "Oh, well, I wrote a Nobel Prize. I wrote a paper too, and it's going to be ready for a Nobel Prize hopefully in the next 5 years." And he goes, "But what I've done is I thought about AI, so I tracked the full nervous system of a worm and then turned that into an intelligent learning system, and then I'm going to use that for AI." So okay. Next guy's like, "I thought about the energy problems." These are all very young children. And he goes, next one goes, oh, I've thought about the energy problems of the world. And, solar panels are actually really, really hard to install. So I've created this film and it looked like cling wrap. And then basically this is a solar panel. So I can retrofit it over roofs, over anything. And he's, again, got a factory producing it. So, these three people have come through MIT. They're being funded by this VC that is, one of the things I found in the US too is we met probably, say, 30 people that were worth over $500 million, and they'd build a business, exit it, build a business, exit it. And they're in their 60s. They've still got this entrepreneurial spirit. They're still going as fast. They're still the nicest people you would ever meet. They're not, show ponies. They're just going, hey. And, so the entrepreneurialism of that is just amazing, right? We don't have anything like that in Australia. There's a few groups that have been trying to get it up, but there's nothing like that. So, really opens your eyes to the opportunities.
Did it give you a new appreciation for potentially having, like when you think about Waddle's portfolios, did it give you a new appreciation for making sure that you have focus on what maybe characterized as American exceptionalism?
Yeah, I mean, we've always had a solid position in the US. And as Drew said before, this white noise or so-called experts, there's probably a lot of people that have deleted their podcasts in the last kind of 3 months because they called US short. US is going to be a problem. Get out of US. I don't hold any US equities. And 12 months later, you're up 60, 70%. Always appreciate you. So I think it's a phenomenal place. When we build portfolios, we do think that, all the growth is going to come from probably Asia and now visiting Africa. I mean, the Cape Town visit was quite amazing in my mind to think about they've got the demographics, they've got the resources, they've got the access. So the next 20 years is an emerging kind of continent. Africa is phenomenal.
Wow.
So we still build portfolios with tilts towards, Asia and emerging, but US is a big core. I think arguably we will, at investment committees, we will debate more and more why we hold domestic. More and more. It's like, because when we started, Drew, it would have been like 55% Aussie
Domestic
equities, right? And like 5%. And now we're kind of even. And, then there's this real global theme coming into it. And even when you look at what you might hold as a recommended portfolio of 20 stocks globally and 20 stocks domestically, maybe we could use CBA versus JP Morgan.
Yeah.
Like, why would you? JP Morgan's like 9 times. This is 28 times. Like, why would I ever buy that?
Yeah.
And I think that's probably going to be the case where domestic is like less than 10% of our portfolios and the rest is global.
I think that's a story around private markets as well. Like the ideas that are coming through in MIT, Harvard, and venture, it's all in private markets. And more companies are staying private. Like all those exits would have been private markets to another private company or to a private equity. And the more innovative, even in AI, all the more innovative companies are all staying private before and never going public.
Permanent capital.
How do you invest in that?
So PE used to be, you buy a business, you rip it apart, you try to list it. But there's this permanent capital piece in PE. And if you look at
Canva,
they're happy to stay private for a long period of time. And I'm happy to hold investments privately. I don't need to be told what the share price is every 2 seconds. I think the New York Stock Exchange has half the amount of stocks it had listed than it did 10 years ago. So there's all these companies that are happy to stay, and they go kind of from PE firm to PE firm to PE firm, but they're happy to stay private. In Europe, you can see the majority of great corporates are actually still privately owned. That's why their market is so much smaller. It's not that they have less companies, it's just they haven't chosen to list. So
wow, that's really interesting. Giles in the chat said, "Merry Christmas, love on the Rask merch. Almost looks as good as Drew's snazzy shirt." Giles,
it's a shirt too. I should have the green hat on.
Merch on sale soon, I believe. So right here.
Some It Depends hats coming through too.
Yeah, Drew's ordered some It Depends hats, so they'll be coming soon. There's also a new clothing line I hear from Drew potentially. We don't know. Maybe in the new year. Jamie, macroeconomic question I'm going to put to you from it's in support or like yay or nay to Drew's forecast. He thinks that he's bet everyone on the show a copy of your book, The Golden Years. If interest
Luckily,
rates,
not many people listen. So we're
That's
fine.
right. We got a lot.
if interest rates fall before the end of March 2025,
Mm.
Drew keeps the books. You guys don't have to pay up. But if
And
interest
Fed
rates
did
don't
cut
get
overnight.
cut,
The
Huh?
Fed did cut 25 basis points.
we're
overnight
talking
too.
Australian market
Yep,
here,
yep,
though,
but that's-
mate. Come
They
on.
good
cut,
sign.
but they said there won't be
No
any
more. Yeah,
further.
that's why the
right?
market tanked,
Market
yeah.
hated it. So
So do you agree with Drew here that interest rates in Australia may fall before the end of March
This is what happens when I
2025?
make my own calls.
this sounds like a lose-lose. What do I get out of this? Drew's giving away all our books.
It could become a bestseller.
Well, there's two. I don't know.
Maybe give us a
I'll-
prob-
There's only two
Probability then.
meetings, and the RBA did come out last
Here we go.
last meeting and said there's no any further hike is off the table, completely off the table, which means there's only
Any
one
further
option.
hike,
Yeah.
of course.
Yeah.
I mean,
But they were
inflation's
hanging
still
around with that
bubbling
one.
around.
Yeah.
And
So two meetings.
service inflation was high, which they picked on, which I thought, there's other things to do. I think rates, probably I'm with Drew. I think rates will be cut in the March meeting, not the Fed meeting.
There we go.
Really?
Anything
Did
can
you just go 25 bips?
Yeah, 25. Just one.
Yeah.
Anything. I'll take
Anything,
anything at the
anytime.
moment. It's a
Isn't
two-
there a
it's a 2-year
isn't there
long.
a stat that normally the first move is 75
Four.
bips?
Yeah. I think the US cut 50, didn't it?
50,
Yeah.
yeah, straight out.
Yeah.
Yeah. So
Yeah,
this-
Can't
I
be
reckon
that far
March.
behind.
I'm-
We're already 6 months behind.
We
them.
share an office.
Yeah.
We share a business. We've got to share views.
I have to keep some of my best ideas
Descent
away
in
from
the
him,
ranks.
otherwise he'll steal them when he's doing some content.
so it's good news for people then, potentially.
Well, Main Street's hurting, right? It's
Yeah.
a residential belt. I mean, people are hurting. You can see one of the things I've noticed over the last few weeks is luxury brands are hurting. Now, why are luxury brands hurting? That makes no sense, right? It should
Yeah.
be sales at Coles and Woolworths, and it should be basics. But luxury brands are down substantially. You see that, just walking the streets. You see that, on the sales of the Louis Vuitton, etc. So, that's interesting. I think, the pain is being felt more than just mortgage belt. It's being felt by everyone.
And it's not random, but it's not like all luxury is doing bad and all low cost is doing bad. It's like just random brand. It's like brand power is winning at the moment versus anything else. Hard to predict.
Some praise for you guys from Jackie in the chat. I do rate the book. Great read. There you go.
There we go.
So, you're welcome.
Have you announced your new book?
You might be
yet?
getting a free copy.
Yeah,
Would you
yeah.
like
Maybe
two?
working on a new book. There we go. That's a bit of news. Okay, so
I want to be ready to write it.
I think so. Drew, when we were just sitting outside the office here, Drew started cooking something, and as you may remember, if you're a regular on the Australian Investors Podcast every Saturday morning, Drew has promised us many things, including rate cuts over the years. But one of the things
was
that
2
he's
years ago
promised
now.
us recently is a live tasting. So he is not the heir apparent to the Meredith
goat
family
cheese? No, unfortunately not.
that runs the goat cheese that we all love. Well, what have you got here for us, son?
I'm not sure how I'm going to do this, but we're going to have a bit of fun with it anyway.
Okay.
And we've been talking about some special spices. So I think throughout 2024. So what I've got here is a bagel from It's Bagel, I think it's called. just around the corner.
Downstairs. Yeah.
And we're going to try 2 different seasonings, and you're going to describe to me which one you like more and the key flavors of each one, and we're going to all share them between us.
Okay. This is new.
This is new.
So
This
maybe
is
hold it
very
up
new.
to that camera there on the left-hand side, Drew.
It
So
looks like dirty toast.
okay, dirty
So
toast.
take the front one first. Take the front one
This
first.
one?
Yeah.
Awesome.
You don't have to eat the whole thing because we
Thank
might be
you.
quite
Okay,
full.
we might just leave that on the
Yeah.
table. All right, so here we go. We got some from Drew. So we're just
Now, this is courtesy of New
Bagel.
York.
New York.
Yeah. So shout out to, I think, Andrea brought this back from New York.
It's just a very mild garlic bread.
All right. All right. That one fell pretty low. That's fine.
No, it's pretty good, but
Just garlic.
just garlic.
So that's a palate cleanser for the important one, the one we've been talking about.
I'm sure
which
you
I know you haven't
clean your
tasted.
palate through
With
garlic.
garlic. Yeah, of course. it's the underappreciated condiments.
So for everyone that's not in Melbourne, if you're looking for good places to eat, drink, have coffee, the 2 probably main areas you want to go: Flinders Lane, all the way up
Yep.
and down.
Which we're both on.
Yep, and then Hardware Lane, which is in the center of the city, where you get a lot of these things like bagels. You get a lot of good coffees, breads, cakes, that sort of stuff. What do you got
Now,
here?
this is a long-awaited one, and there's been a shortage since we talked about it on the earlier in the podcast. It is known as everything.
Everything eggs.
Yes, but also has another name, which is everything.
Everything.
Because it goes on everything.
Okay, so Drew talked about this, Jamie, on the podcast probably mid-year, and then
You went to Coles and Woolies?
a few of the folks in the community went to their local Coles and Woolies, and it was sold out.
Really?
Yeah, sold out.
So
Massive
Because of
shortage,
Drew.
here we go.
apparently.
You're a pretty gourmet guy too, Drew.
Yeah.
What-
Like to
You've-
cook.
There's the
You gotta put
clothing
some
and the
eggs somehow.
food.
I'm not sure.
You
this
can't tell
is-
people I put mayonnaise on eggs either. That's kind of a no-go as well.
I've never had this everything eggs thing. This is some Master Foods, not sponsored whatsoever.
Not yet.
This is really good.
Mm,
This is
isn't it?
really good. You don't want to put too much on it. It's pretty
Even on dry
salty.
toast. Mm.
It's kind of like a Moroccan spice, but
It's better
Wow.
than the garlic.
Here's something I
Yeah.
prepared earlier.
so there you go. Hold that up to that camera there on the left.
You are correct. The main ingredient is garlic,
Isn't everything?
followed by
Could have
chives,
reflux later.
parsley, thyme, capsicum, paprika, onion, chili, black pepper, and garlic oil.
Well done. This is probably
that's my
worth its weight in
present to
gold.
you.
This is probably worth more than
Yeah.
if Bitcoin.
You may not be able to find it this weekend.
Wow, the Drew
So
effect.
is it worth the wait?
This is pretty
Will it
good.
become
I'm
a
not going to
Saturday,
lie.
Sunday
This, if you
staple?
have allspice at home or you have Moroccan eggs, try this everything eggs. This is something else.
Not an ad.
Not an ad. Brought to you by
Not yet.
Master Foods. Well, that's good.
It's a nice
Good
little
content.
segue. I've never
Uh,
tried that.
Giles says, Uniqlo or Road and Gun, Drew?
Both.
Both.
Oh, this T-shirt.
Yeah.
This is, I think it's Country Road,
Country Road.
Yeah.
Wow. Must be nice.
but love Rod and Gun.
Aisha is vehemently in opposition to you guys. No way interest rates will fall. Aisha, thank you very much.
Okay.
Yeah, I'm in your camp. No, I don't know.
Either way, you're going to get it.
There will be no rate cuts, says Mark, in Australia early 2025, in my guesstimate. However, as a borrower, I hope there is a little cut for general confidence. I agree with you on that one, Mark, as a borrower myself, as a very significant borrower.
No conflict.
Borrower of money. So I can, I can get behind that. Now, gents, we do have some questions sent in advance. Please, if you're watching on YouTube, LinkedIn, Facebook, even the Mighty X platform that's run by the king of Doge himself, get your questions in, and we'll have a go at them. But there was one question sent in advance, which I'm curious to hear both of your perspectives on. It comes from, and this is the questioner name. We always ask for funny names. This one. 1-1 was a horse race. 2-2 was 1-2. 1-1-1-1 race, and 2-2-1-1-2. They
Is that
say,
the question?
hey guys, with IVV, which is the S&P 500, beating NDQ or the NASDAQ 100 in returns until recently this year and only being outdone over a 5-year period or longer, do you think NDQ or IVV will perform better over the next 10 years? Which fund would you prefer to hold and why? And it is a general question. I must stress, we don't know your needs, goals, objectives, and clearly we have no idea who this person could possibly be. If we talk about
I feel like
ETFs,
they might have a racehorse.
potentially.
So it's NASDAQ versus S&P.
Yeah.
NASDAQ versus S&P 500 for US shares. Love the chats and banter, they say. Again, read the product disclosure statement and TMD of any ETFs or financial products that we mentioned before deciding to invest or
Can you
acquire
short?
the product.
Can we short?
Can we get?
Okay, so what we're going to do while you riff on this, Drew,
All right.
Monique, can we bring up the chart, please, and give us a thumbs up so everyone can see it when you let me know, and I'll bring up the returns for everyone. Okay, we're up. Just as an FYI, the IVV ETF, so this is like US dollar to Australian dollar, 34% over the last year. NDQ,
48.
35.
Oh,
I've got it by mine
sorry,
up
that
1
was-
year. Are you doing year to date?
That was a guesstimate.
Oh, okay. So they're both up exactly 12 months.
I just made it up.
Year to date, 12-month returns to the time of recording, exactly the same returns
Why is Costco in NASDAQ?
because it's NASDAQ listed.
Is it?
I'm pretty sure it is.
Yeah.
Is it? Yeah, I'm pretty sure it's one of the biggest non-tech companies on
The
the.
NASDAQ, yeah.
Yeah. So would you go NASDAQ or would you go S&P 500, gents?
I mean,
Generally speaking.
before I knew about Costco, I would be always go on the S&P 500, just broader sector diversification. It's still got like 45% in technology in the big tech companies, but it's got a much broader exposure to financials. So the JP Morgans, the Goldman Sachs, the Wells Fargos, and then goes into healthcare, Eli Lilly, some of the massive healthcare companies. So for diversification, and part of that saying, will the broader tech sector continue to perform strongly in throughout 2025? It's probably a bet on sectors outside of tech doing well, apart from Costco.
Question was 10 years though.
Yeah, 10 years. I think I'd still take it over 10.
10 years.
Yeah.
I would agree with you. I think NASDAQ can fit both in the core and the satellite for what it's worth.
Yeah.
There's some interesting stats, however. Like there's a big part of me that's like torn by this because I saw some data the other day from BetaShares, full disclosure sponsor of our finance podcast. BetaShares has some literature around the NASDAQ 100, which says that from 2003 until recently, I don't know exactly when the study was concluded by NASDAQ, the revenue growth of the NASDAQ 100 companies compared to the S&P 500, 4x more.
Yeah.
And, over time, like we've seen some of the greats in there, wonderful companies, Apple, these really innovative companies, NVIDIA, these types of businesses.
So because it has larger weightings to them?
Well, yeah, because of 100 companies, you get a lot of that tech. And NASDAQ also, it effectively excludes financials.
Yeah.
And they're kind of capital intensive industries by its design. It's focused on healthcare, consumer discretionary, and obviously just tech broadly. So you end up with kind of a more concentrated basket of those three things. But I am also of the opinion that I like diversification in the core of a portfolio.
And likely you're going to have more volatility. Like the NASDAQ's 49, as you said, 49% tech and 16% basically 30% consumer. So 80% into two key sectors of the economy.
Define tech now, because everyone's tech, right?
AI.
Yeah. Graham says, is there too much overlap having both NDQ and IVV? Jamie, how would you respond to the just broadly NASDAQ, S&P? Does it matter that much?
I'm not to offend anyone.
We always like it when that comes out first.
Start with that. Yeah, what comes next?
I really worry about concentration risk. I worry about everyone going into index funds thinking they're phenomenal and just buying the best performing things you're buying the most of. So my mind thinks about how do you get diversification. And, if you look at the S&P 500, it's a good example, right? 7 stocks are 30% of the index. They all trade at mid-20s. They're all phenomenal stocks. I'm a fan of all of them, right? They're all growing by 30% per annum and happy to pay mid-20s. And then you've got the rest, and they all trade at 15 to 16 times. They're all struggling for real growth, 15, 16 times. I'm probably okay with that. So you kind of got the haves and the have-nots. We've been post GFC. One thing's worked really well, momentum. Index funds are momentum based. So we've had 15 years of boom on momentum, just one methodology. So if the question is about the next 10 years, I would take whatever had the least concentration risk and the most amount of stocks.
Less volatility.
I think, where we sit at the moment, we're sitting on 2024, phenomenal year, but is it a 2006? Maybe. Not sure what the future is, right? So I'd say we invest in both. We invest in S&P 500. We invest in NASDAQ. NASDAQ, historically, personally, I've traded it a bit. So I'd go from not holding it to a geared position and not holding to geared position. And if markets fell, we typically would buy something geared on the NASDAQ to kind of get some quick alpha. But, so I'm not really answering the question. It's probably just my thinking around which one would I buy, and if I had a choice 3, 4, or 5, or 6, I would probably want something a bit more balanced in its allocation.
And one isn't enough. That's probably our constant message as well. But it might be great, but you got 40% in, even in the S&P, you've got more companies, 500 companies, but 40% in 2 sectors.
So Jamie,
so this theory,
go right.
The theory about how do you build a global portfolio over the next 10 years that Waddle has, that we hopefully share, Drew. Just not.
We'll wait till New
It's
Year's
like-
Eve.
Yeah.
What you really want to do is build a portfolio that outperforms the S&P, right? That's that's Goldilocks. So how do you do that? And our methodology as well, there's two things. There's a cap bias that will work, mids to smalls, the next NVIDIA, not the current NVIDIA, and regional tilts. So our regional tilts, overweight Asia, looking at emerging, and then a cap bias. And if you're bringing those two markets, arguably more inefficient than efficient, and adding them to a portfolio, then you should be able to outperform the S&P over the next 10 years. Sure, you'll get short-term underperformance and outperformance as US charges ahead and Asia's got some issues. But, if you think about that methodology, it kind of works. I think it will work.
What's repeatable and
so then, how do you get Russells? Probably once you start getting into asset classes or sectors that are inefficient, you want some active, right? So who's picking the eyes out of this? So we always use, any efficient market, we would use some kind of index fund or a balanced version. As soon as we're in an efficient market, we're using some kind of manager that has a skill. So.
Okay.
And that's about smoothing the ride completely, because ETFs are great. You're getting the average. You're guaranteed the average. You're going to get the market return. But if the market falls 40%, you don't necessarily want the market return. So how do you get those pockets of diversification that smooths that? And
good one
for us, makes it easier. Makes it more easy is the best word to navigate those difficult periods without having the feeling that you need to sell.
And then what will you do? When you lose 40% in an ETF, everyone's views are, well, that's been a terrible ride. Well,
I got to protect my
assets. Got to buy more, right?
Yeah.
It's essentially the rebalancing coming back in. So
if someone walked into Waddle today and they had a pretty reasonably well diversified portfolio, and in that they've got NDQ and IVV, would it phase you that they have both, or do you think about it like it's more holistic than that?
I'm going to do what we tell everyone else to do and not answer your question, but make a statement. And the statement is, Drew and I have probably seen 1,000 clients that have come in our door in the last 7 years. And out of those 1,000 clients, we've probably seen 10 people that turn up with portfolios that make any type of sense. The other 990, you go, well, what are you doing?
And some of them come from advisors.
A lot of them come to advisors. I'm not saying it. No, that's a really good point, right? You're like, what do you? And advisors are probably the worst because they believe their own rubbish, right? And we've seen. I mean, that's a really good point, right? Some of the advisor portfolios we see out there are just ridiculously poor. So, but from a construction, you're talking about from a construction, from a building a portfolio for a goal. And a good example I was thinking about this morning is, anyone could build a house, right? A house is not too hard. You put a roof on it and 4 walls and that's a house. But that's what a lot of portfolios are like.
Yeah.
It doesn't keep you warm in the winter. It doesn't have any luxuries. It probably get blown down in a cyclone. Still a house. And that's kind of like a lot of portfolios we see. It's just a house. But you actually want something that's bigger and better and more robust than that, especially when it's every dollar you've ever. I mean, remember, we do retirement. Every dollar you ever earn, and you can't earn any more money. So then you've got a different mindset. When you're earning an income and you're young, like you two,
take that.
Then
I'm in your camp.
You're welcome.
You can earn some more money, right? But once you're there, you want a house that's got air conditioning and heating, and it's got it's got all the trimmings, and that's a fully diversified portfolio versus.
I mean, ETFs are at the core of most of our asset classes, so it always starts there. And then a big thing we look at is like your fee budget and what fees are you spending to get the exposures you want. Are there better ways to get those exposures? So that's why I'm answering your question to Jamie, which was the S&P is probably the one you start as your call. The NASDAQ's 50 basis points. And are there better ways to be spending that, or 48 basis points, or 0.48%? Are there better ways to be spending that 0.48% that's going to be more impactful and add more diversification benefit than buying another index alongside that?
Dean is in the chat and says something which is quite interesting and quite relevant to us talking about ETFs. An ETF I am holding is being closed. The two options are I can sell the shares on the market prior to it being closed, or have my proportion distributed post the closure. is there a general approach that you guys would follow? We've seen some ETFs close recently. Globally, a lot of ETFs do close,
Sure.
and people think that's the end of the world. It's not. You can
Just get
typically
the money back.
Yeah. So
Which one is it?
I think I could be mistaken. Hopefully, I'm not. But I think BetaShares announced the closure of some ETFs recently. Dean,
9 ETFs. Yeah.
yeah. So this is pretty common. We saw.
So
I
you
think it
can
was
sell on
Russell.
market
UBS
and
did
you
it a
just
few
get
years
your
ago.
money back, right? It
Yeah.
should be the same, shouldn't it?
Yeah,
Same
it should
chain?
be the same. It's just really just the admin of like waiting a little bit longer. So I personally, no personal advice here, but for my personal self, I like to have more certainty when I can have certainty. And so for me,
You would sell it.
just sell it.
Yeah.
Yeah, that would be my, because then I know what's coming in and when.
Yeah, and then
And
you've
this is some
got your money
tax
back. And the
And
key
if
thing
the
here is that
market maker is doing its job.
you know you're getting the value of your shares regardless of what happens. But it's how do you just get certainty and move on and probably reinvest it.
Do you
Yeah.
guys talk about market makers much and what they do and
A little bit.
responsibility and what the real risk that could be of market makers?
Yeah. Okay. So we'll give you. Okay, we're going to do it. We'll give you 2 minutes to
Explain what a
explain.
market maker
There's a
is.
camera over there.
I want to come back next year. So I wanna get market makers to next year. But
No, so give us the juicy stuff real quick. Imagine this is like, I don't know, CNN, and you've just appeared. Jamie Nemtsas, what does a market maker do in an ETF?
well, they
just gonna
do
eat
what
some
they
food
say,
while
right?
we
They essentially mark the market. They make the market. So when you buy an ETF and there's not enough volume because they have to trade at NTA, there's an investment firm sitting at the back to make them all up. So they're buying all the stocks in the S&P to create new ETFs, new units in ETF, and vice versa. If there's too many sellers, not enough buyers, they're decoupling them and then selling the shares directly, right? So it's a really important thing. If you think about,
Yeah,
if you
definitely.
start, and it's Christmas issue, so it's all happy and great. But when you go, whoa, what could go wrong with the world? Well, there's so many ETFs in the world. There's so many market makers. Who do you trust? And what happens when an ETF doesn't have a market maker? What happens there?
That is the one thing. I've got to be real. That is the one thing that keeps me up as someone that invests a lot in ETFs. That is the one thing.
And a lot of people don't talk about it. A lot of people don't even know what it is, right?
It's probably because they don't understand it.
Yeah, don't understand it. And then you do get some variances to net tangible assets, overnight. And sometimes there's no volume and you have to put your volume in and have to wait for some market maker to create it or not create it. I feel probably a bit like you, a little bit nervous because I don't know enough about it. But then you think about all this money going to ETFs and what does that actually mean, where you're actually taking shares creating these products. I think there's more ETFs in the US market than stocks.
More probably, yeah. I think it's more funds. Yeah.
It's kind of crazy if you think about it, right? So, and what does that mean? If you get a massive sell of an ETF, which I'm sure there'll be some kind of crisis at some point, and everyone's selling down at the same time, can you actually backfill that quick enough? And who takes the risk? Is it us? Is the investor? Is it the ETF provider? Is it the market maker? They're all quite complicated contracts, which we're not privy to. So
I think there's something in here, which is that the market makers are separate to the ETF providers. Firstly, for people's understanding, and the ETFs have survived a few crises. Like we've had the GFC, we had the COVID crunch, and then there was like the debt ceiling and all that in the 2010s. But during the COVID period in particular, I think it was the CRED ETF, and this is an illustration of what we're talking about. I could be mistaken, or maybe it was the hybrid, the HBRD ETF. Effectively, what Jamie's talking about is the what happens when you buy an ETF is someone has to go and buy the assets inside, and we price that at NTA, net tangible assets. But sometimes the share price of an ETF can deviate from the actual value of what's inside, and we saw that during during COVID, I think. And the thing that I don't know about you, but the thing I've always taken comfort in as an ETF investor, I think, when the time comes and it gets pretty scary, I've probably just got to resign to the fact that I'm not going to trade during that period. I've got to just think to myself,
put it away.
I have to walk away. And that's the risk that I take as an ETF investor is there may be a time where I'm frozen. I can't do anything and I just have to accept that.
Sure.
That's probably like where I recede to.
And that's when the spreads pop out too. Yeah. In very rare circumstances.
Yeah, spreads pop out, but the whole market's got contagion. So you're seeing buy-sell spreads on stocks, which are,
CSL was opening 8% lower.
Yeah, that's right.
On the open.
So overall, very good news for ETF investors as they democratize investing, but there are risks. And I think that if you got a bit
There's
lost
risks in
here,
everything there, right?
the key point is that you guys build portfolios at Waddle, which are not just ETFs, not just index funds, not just stocks, not just bonds. It's everything, right?
And that mix will change kind of year in, year out, depending on what we think, right? How do you make, and it's pretty simple, like you've been preaching this for a long time. How do you understand your risk profile? How do you find investments that can actually add value? And if they can't add value, how do you get exposure as cheaply as possible? So
I mean, the benefit of the structure is that it's the opposite of what a listed investment company is, that it's open-ended, that constantly issuing new units versus a listed investment company where 95% of them, or could be more, trade at a discount to their net tangible asset value because they can't create those new units as they go. So it's kind of those.
The other thing that was interesting on this US trip, Drew and I were in the biggest wealth conference. You've probably spoken about this, biggest wealth conference, right? So, and all the US institutions, and we kind of turn up to all these stands and go, "Oh, g'day, we're Australian investors," and they're like, "Okay, whatever."
So take your free book and
no
get out of
interest
here.
at all in this little pool of money that's Australian. It's just
too hard.
We don't serve Australia. No. But out to ETFs, no. Buy it on our market or go away.
Too many W8Ben forms. Worried about.
Ryan says, why do ETFs close? And they close because the ETFs don't get big enough. Because the ETF provider has to make money from them. So if the ETF, say, stays below $50 million invested for years, it's probably not profitable for the ETF provider, so they should close them down. And you get notified when that happens. There was a good question that came from Facebook, actually, from Gerald, which says...
Are we on Facebook too?
No, we're everywhere, mate. How do you know if your ETF has actually bought the shares? And the answer is, as far as I'm aware, you don't.
Well, there's synthetics too, right?
Yeah.
So once you allocate the market maker is an investment bank, they're not going to be able to trade every single stock. So they just have to guarantee that and they take the risk. That's how investment banks make it. I'm sure there's stocks they don't buy, but you're still getting the performance. Guaranteed.
And that's the role of custodian.
I should make a mention of like how the market makers make money. They make money by taking the difference between what they can buy the shares for and the price of the ETF.
Oh, the Roaring Kitty.
What?
Roaring Kitty.
What is that?
Were they market makers or they were the ones placing their...
I don't know what you're referring to. Are you talking about NFTs?
No, Roaring Kitty back in meme stock.
Oh, right. Okay. I'm not 100% sure.
Market makers. They were
Something
selling the shares off.
So the fundamental, I do not remember this. It's a bit on the zeitgeist for me there, Drew. I don't actually understand.
I've watched that movie on a plane.
But the key thing here is that when the ETF blows out a bit, is that there's an incentive for the market maker to actively bring that down because if another market maker comes in and sees, well, there's a big difference, I can make money here.
Sure.
The next market maker instantly undercuts until it comes back to lower the spread. And that's, but you just, that, as you said, that you rely on each of the market makers surviving this time.
Sure.
So there has to be multiple market makers. Otherwise, there's no incentive for them to close the gap.
Yeah. I mean, ETFs have been a wonderful product for investors and all types of investors. And then one of the great things is the simplicity that they provide for us, right? We can get exposure to markets all over the world. And some of the innovative products that, BetaShares has created, fantastic. The bits behind, like a lot of things in life, do we know everything?
Yeah.
No, we don't know everything. But, the product that we see and we get 99.9% of the time, it's going to be great. And like financial planners, phenomenal financial planners in this industry, 90% of us, 10% of us shouldn't be in the industry, right?
Yeah.
So I'm sure ETFs around the world, there's great providers, and then there's others. So probably stick to your brand names, make sure they've got some credibility and backing, because a lot of groups, one of the reasons to always have big names behind it, they typically make good anyway, right? They don't want a product that there's got a slippage, because they've got a brand and a reputation and a business to make sure. If you ever look at the ETFs that have closed down, I bet you a lot of them are from small brands that have tried ETFs and can't get scale, right?
All kind of timely thematics.
Some thematics go out of fashion,
weren't as
right?
broad as they.
There's some good questions flying in.
Yeah, cool.
thick and fast. Graham did make mention of the ETF providers nominating one market maker. But Graham, if you go into a PDS of an ETF, we won't spend any more time on this because it's pretty nerdy. But if you go into the PDS of an ETF, what you will find is there's a section dedicated just to market makers and what they call authorized participants. That information is to tell those market makers how to basically serve the ETF provider. It's not for you, even though it's in the PDS. And that's basically an invitation for market makers to come in and say, start servicing or trading in that ETF. I hope that makes sense. And you did say you followed up with additional market makers would join the arbitrage party. Now, before we get to some good questions here, I want to get a real quick answer out of you guys, because I did ask you to prepare this one in advance, and I probably struggled the most with it, is one bold prediction for 2025. It could be anything. And everyone here that's watching or listening live, chuck your bold prediction in the chat, because I would be fascinated to hear this. Who's got one? Who wants to go first?
I'm ready.
All right, Drew.
The Magnificent Seven will underperform an equally weighted S&P in 2025.
So you reckon the other 493 will do better than the top 7?
Yep.
So I don't think there's actually 500 stocks in the S&P 500.
Yeah,
497. Yeah. Or 503.
Yeah.
I had another one there, but I went a bit narrower on that.
What was the other one?
That US equities will underperform.
Really?
Yeah.
Relative to what?
Everything else.
You reckon US shares will underperform?
Like Asia, like
There's lots of people that don't have jobs
yeah.
after calling that 18 months ago, Drew. So
So you lose our win situation.
Well,
it would be like any other market will beat the US.
Wow.
So Europe will outperform the US, or Asia will outperform the US.
I've got it's very similar to yours, actually. I don't think Nvidia will end the year more than 10% higher.
Okay.
I think there's a lot of
bold call.
I think there's been a lot of growth that's baked into that. Now, I could be completely wrong.
Google that.
No, I just got it in my notes here.
Yeah.
this is bold predictions. Right?
Yeah, this is a bold prediction.
I think that if you sold everything, put it in cash, you'll have more money in 12 months' time than being actively invested for the next 12 months.
Whoa, okay.
It's very bold.
Well, cash is going to give me 5.5, right? Diversified portfolio doing 5.5. History says they do about 7.5 or 8. Last 12 months, they've done 20 to 25. Every time we've had a phenomenal year like this, it's followed by a year that's gone sideways at best. You've geopolitical pressure, you've got interest rate pressure, you've got inflation pressure, you've got, margin pressure on everyone else apart from tech stocks. Depends how your portfolio is balanced. Yeah, we're not telling
Doesn't mean you should do all go to cash.
The prudent in the podcast Drew and I do, actively rebalancing next year will be super important, right? Go back to basics, cut all your winnings, reinvest in asset classes that underperform. Absolutely do that. That's my prudent. Yes, but you asked for a bold prediction. Bold prediction would
calling
be
the market lower.
When we say, well, I've got a 5.5% buffer, Drew.
Yeah.
I haven't got no, it's not neutral. I'm going to say that, let's come back in 12 months' time and see how wrong. See if we have any clients left.
So we're going to put that down in the Kylie agrees with you, Jamie. We're going to put that down in the Hey Siri bucket and get it to remind us in a year from now.
And everyone loves fear too. Like, it's so easy to justify selling. So it's kind of, I like the negative prediction.
Yeah. Bold prediction, Jamie says, Sona, in light of that, cash in the bank or something like AAA, which is the BetaShares cash ETF, like cash in hands, cash.
I'm old school. I have 1 year term deposit with a bank.
Term deposit 1 year.
Yeah.
Wow. Dean says 2025 is the year of the small caps. John T, tongue in cheek, of course, or maybe semi-serious, says the market will go up and down. Like Graham,
That's all you need to know.
Graham says Europe will be a basket case and relative country performance. Jan van Eck said in an interview that the USA markets are under a cloud. He prefers India and China. Sounded more like a stock picker. This is for his personal account. Marco Schenner. Marco, thank you for the Christmas hamper. I finally collected that, and thank you so much. I will be writing to you separately. My prediction, no interest rate changes until 2027.
2027.
Labor will give away more money next year and win the next election. There's like 3 things in that.
There was a bit, the budget came out earlier this week, and it's another decade of budget deficits, which means more money is going into the economy. over this period at the same time that the RBA is worried about inflation. So, I mean, it's a good point there too.
Yeah. I think that's very interesting.
Not good for me. Us.
Not great.
Only 50% of the books are mine. The other 50%.
I'm going to take a question from Jonty and put it to the both of you guys, because you deal with a lot of retired clients or clients who are not yet at retirement age but could retire and are living off income. Jonty did ask a question about using a cash ETF in order to live off dividends for the long term. I know it's not as simple as just saying what goes into that portfolio, but even for someone that's living off income, I'm going to assume that you don't do the bold prediction, Jamie, and it's not just a 1-year term deposit. What does a portfolio for someone living off dividends look like, broadly speaking?
And yeah, the US trip helped us with this as well, talking to a lot of US financial planners. So, and we've done this for a long time. It's really what kind of cash or cash buffer do you need, especially in a balanced portfolio, to hold out not selling investments. And I think top to top in a balanced portfolio is about 9 years. So it's like 9 years that your balanced portfolio could fall before it gets back to the top over a kind of 100-year period. So on that basis, and portfolios typically, let's say they produce passive income of about, I don't know, everyone has numbers, say 4.5%, right? Yep. Famous number's 4, but let's say 4.5%. So you can do a mathematical equation, and maybe we can share it at some point, Drew, and go, well, how many years living on the income that I want to live on the basis that the portfolio produces 4.5%, and in that 9 to 9, the income dropped 40%. So you got to factor that in. So you're at 4.5, drops 40%. So you're at 3%. Now, if you want an income stream that's higher than that, hold it in cash and term deposits. What really happens once you do all that with most risk profiles is you end up with a 30-70 portfolio, 30% into cash and fixed income, 70% into market. And what would happen is you would draw off you a certain amount of income, and then you'd be selling down your non-market linked assets over that period of time until the portfolio got back to a certain point. The trick is, when do you rebalance? So if you're doing that and you're in a 9-year kind of downward cycle, then you might want to rebalance in year 5 or year 6 or year 7. So I think it's a pretty simple formula of how much cash you need to have, and have true investments that aren't volatile, and that you can sell at. We're still a bit old school. Hold cash, hold some term deposits, hold some things that you can sell. And sometimes it's okay to redeem an investment to fund your lifestyle, especially in retirement. Drew and I have been talking about one of the things that retirement used to be that you retire at 65 and you're dead at 75, right? So your capital just lasts 10 years. And
a lot of the comments on YouTube are around that as well.
Yeah.
Which is why I plan for 30 years, where everyone, I'm only going to last for 10.
Yeah.
But that's not what the numbers say.
And I think they're going to get worse or better.
They're going to live longer. But
we say most people, if a client comes and joins us at 60, we say, well, we've got 30, 35 years, right? One of you going to live to 95. And roughly, the stats say that roughly. I'm not going to quote anyone, but roughly. But it could be 105, right? It could be 115. Because you've got 30, 35 years. You think about technology, right? So now you're retiring at 60 and you've got to manage money for 50 years, 55 years. So there's a need, and we don't know. Drew talks about annuities as potentially a hedge. So what is your longevity hedge? And I think that's going to be something we're going to talk about a lot in the next 18 months. It could be an annuity, a lifetime annuity that someone else has got your risk, so you're outsourcing the risk. It could be a deferred annuity that starts at 90 and goes for the rest of your life. It could be, I like always been a fan of and they're not a sponsor, but Colonial First State. So First Sentier Geared Share Fund, right? It's an internally geared fund. So do I take my portfolio and put $400,000 or $500,000 away from my portfolio? I'll lock it away, and maybe if I did lock it away, I might use a structure like an investment bond. I haven't got that far thinking, but you put it away and you go, that's my longevity. It'll just sit there, produces no income, and I'll ride cycles over 30, 35 years. And if I get to 95 and go, I'm pretty fit, I'm going to live for another 15, I've got a hedge. And it's separate to my main strategy, nearly bucketing.
So something that protects in the case that the main portfolio doesn't deliver that longevity of income.
Or you've spent it all, and yeah, that's right. So the most of our clients happen to be wealthy, and they have enough money, and they're not spending. We talk about the 3 kind of periods of retirement. They're not spending all their capital, but overall, I think that's the biggest worry. Finite capital at 60 or 65, you're not going to get any more. You can't work anymore, and you just don't know how long you're going to live. And that's the scary part, right?
Yeah.
So as planners, we need to at least provide options to clients. Go, well, what about longevity risk? And what does that look like? And what are your options? A bit like when you buy a house and you take out home insurance. The chances of your house burning down is 0.01, but you're still taking home insurance, right?
Yeah.
So what does it look like for a retirement couple or retired couple? And how do we kind of articulate that to be the next generation of portfolio construction?
Yeah, that's really interesting. Well, speaking of something you guys talk about, you can head over to the Waddle Partners YouTube channel. I believe these guys may have gone semi-viral, at least for the
Comment away.
Comment away. Let them know. Get
Join
stuck
the
in.
community.
Get stuck into them over on the Waddle Partners.
We don't
YouTube
need
channel.
any more people to get stuck into us, Owen. We've got enough.
Aisha says, I think Berkshire will end up in the Mag 7. That's a prediction. Steve says, Trump won't get one of his financial amendments through. That's quite bold. Graham did comment and said his statement, as you would say, Jamie. As you get older, you need less money to live. Done all the holidays, more likely or not, can live off the age pension in a worst case scenario. To an extent, I'd agree with that, Graham. But at the same time, medical bills tend to get more expensive as you get older as well. So that's
we've got that. Silver years, golden years is where you have time of your life. Silver years is where you spend a lot less money. Then you go into this really complicated bit, which is called legacy years and healthcare costs and changing houses, and that does cost a bit of money.
Yeah.
It's something we covered on the Australian Retirement Podcast.
Yeah.
To be out in the next week or so.
Yep.
As well.
Yep. Gents, this has been heaps of fun. And we did. Okay, we'll end with one question. Do you have a dad joke for us as well?
I'll work on it. Yes.
Okay, you work on that real quick. We did have one question and we alluded to this at the top, so we've got to finish it off at the bottom. It's Soul Man! Wrote in, and of course, general advice, they exclaim, which is good because that's all we can give. I have 40% of my portfolio in Soul Pats, another exclamation mark. Very enthusiastic. It's going great guns. Went to their recent AGM. And something about something. Oh, they're branching out into international stocks, private equity, Jamie. They say credit and small caps, which credit's been there for a while. Private equity's been there for a bit. It's a one-stop shop, another exclamation mark. Okay. I think you could maybe get a sense of bias from the amount of exclamation marks that someone uses when describing a company, but that's okay. Is it stupid to think you can allocate capital better than one of these guys? And should I just let Soul Pats continue to grow and compound without rebalancing in other assets when they do it for you? Cheers, guys. So it's obviously Soul Pats is a very popular company investment.
It's not really
firm.
a company. Right?
It's more like a
portfolio.
It's a portfolio with one share price.
Yeah, and they've done incredibly well, right? There's diversified exposures in there. Their track record is great. You're kind of like buying the Waddle portfolio in a way.
Yeah.
So it's not a one stock. And we have this question all the time, right? Lots of clients come in with one stock. Depends what the stock is.
Yeah.
Depends what the investment is. And if you're going to justify 40% into any investment, at least have it as diversified, right? So
that's probably of the individual stocks. That's probably one of the least bad.
Absolutely, yeah, least bad. Yeah. So,
yeah.
So I mean, would you have 40% in the S&P 500? Sure, Yeah. So there's similar kind of thing, but you've got active management. Soul Pats, as much as ETFs are index, Soul Pats is an active manager. They're making active calls on the capital that they have to put into various investments to outperform the cost of capital. So yeah, I could live with it.
Oh, interesting, Drew.
40%
Soul Pats.
Yeah, I think it was exactly the same story like we've talked about. Wes Farmers is an example in the past. It's a business that's allocating capital, owns even more companies. I think it's even more well diversified. It's in credits, in private equity. It's in operational businesses. So as a rule of thumb, you want something more heavily diversified in a core portfolio, but it's not something that would completely freak me out.
The rule would be 10%.
Yeah,
in
a
no
direct
more
stock.
than 10%. But But interesting, that debate about active versus index. Yeah, and that's an active. Yeah, that's essentially an active fund manager allocating capital. So
yeah, and it touches on a few of the things which you've mentioned, which are things like it's permanent capital in some ways because they're private equity. They kind of buy whole companies.
and hold for
A very long time. They're founder family led. So there's a lot of things there. So as we come to the end, Jenny says, my New Year's resolution is sell the dogs in my portfolio. Well, yeah, we could probably all do
Don't you
some
supposed
of
to
that.
buy the dogs? The dogs are the DAO.
Dogs are the DAO, Jenny. Yeah,
that does incredibly well, right?
So I was deep in Reddit trying to find
Andy from NZ, good to see you, Andy, says, great conversation topics. Thanks, guys. We'll be back to do loads more like this, Andy. Love the podcast, says Dean. So good, avid listener. Just finished reading Golden Years. Good read. And I plan to die with zero on the beach over summer.
Beautiful.
Over summer.
I don't know, Dean.
I keep talking about reading the book.
I read that verbatim, though. So I hope you don't die on the beach over summer, but
with zero.
With zero.
It's a good party, right? So.
Yeah, it's going to be a big summer, Dean. Maybe reading it on the beach over summer is the way to go. As Andy says, hopefully not this summer. I'm going to make one more bold prediction before we get your dad joke.
All right.
My bold prediction is that Jamie will be back on the show more next year.
Then
Maybe.
Yeah,
maybe.
I'm turning 50 next year.
That's perfect. We
So
can
he's
say
not in the
119
office
days
for an
until I'm
entire year.
50,
119 days.
Yep. I'm going to do 50 at 50. So if you boys want to join me in one of my 50 items that I'm going to complete when I'm 50.
Do we get to choose which one?
Yeah, I'll give you a list and you can choose. You'll probably be in like 12.
20, 12.
As someone who hasn't reached this milestone yet, what does that mean?
I just made it up.
Okay.
So essentially, the year of my 50, I'm going to do 50 things that I've ever wanted to do. It's like a pre-bucket list. So what do I want to do? So if it's
cool.
Shave our heads.
Yeah, why not?
Yeah,
probably won't need to by then.
Shave, mine will be quick. So maybe I can share my 50-50 list and
let's do it.
Both of you to join in to something.
Yeah, absolutely. Love it. Now, Drew, you got to get your dad joke out. Minres or BHP says Game Bread. I'd go BHP. I like BHP. Go on.
Oh, you ready to go? Sorry, I was deep before, and I thought this one was timely. We were talking about dying with zero at the beach. What do you call seagulls that fly over the bay?
Gulls?
Bay gulls.
It's very timely. Make sure that's on camera.
Yeah, there we go. That's the one right there. Bay gulls, says Drew.
That could be my best. That was 2 laughs.
Yeah, that was very good. We didn't expect it.
When I blacked out during that question.
Did you know the first French fries weren't actually cooked in France? They were cooked in Greece. Graham, that's another good one. An absolute cracker. If you do want to get in contact with us, there you'll find a link in the YouTube description or your podcast player. You can head to wattlepartners.com.au. There's a link in there. Head over to the Wattle Partners YouTube channel, hit subscribe because they're coming out with videos at least every week, normally every month with a monthly update. You can hear from Jamie and Drew directly about the portfolio. There are a load of great podcasts coming up. In particular, I will call out one episode that's just released on the Investors Podcast, and it releases tomorrow morning on the Australian Finance Podcast, which is the year in review. It's just all of the best podcast episodes in 90 minutes, really. So go and check that out. Graham's come back. The fattest knight at King Arthur's round table was Sir Cumference. He acquired his size from too much pie. We should get Graham on to do the sign-offs from now
He's just
on.
on Reddit. He's just cut and pasted from Reddit.
Well, guys, this has been heaps of fun. Absolute cracking year. Thank you for all the support to both of you. It's been a huge year. Thank you to everyone that's watching and supporting both Rask and Waddle this year. It's been an amazing year. So, Drew, firstly, thanks for joining us as always.
Thank you, and thanks, Mon.
Thanks,
doing
Monique.
all the hard work.
Pizza behind the screen there. And Jamie, mate, thanks for joining us. It's always a pleasure.
Yeah, well done to you, mate. Really bringing financial literacy in Australia up to where it should be. So really,
Snaps.
Snaps.
Maybe bring it up.
Sorry,
Maybe this episode. Maybe you bring it up in this episode.
We're
The two of us bring it down.
Yeah.
Drew brings it down.
Bit
It was a very low level. So
At least I'm
we're
laughing
up,
at other
right?
people's
It's
jokes
always
today.
been
It's
true.
good.
We've got some good
You
jokes.
should
Yeah.
just do a dad joke session.
That's it.
No, this is awesome. So, absolute pleasure. If you haven't already read the Gold News, it's out. You can get it. And if you did get a question on the show today, remember you can write into us and we'll send you a copy as well. So, thanks everyone. Merry Christmas. Happy New Year. Don't forget, great podcast coming out. Jamie, Drew, thanks, fellas.